Today, I am here with Dino Champagne from Asset Preservation to talk to us about 1031s. So Dino, give us a little bit of your background, what got you into this?
Perfect. Ben, thanks for inviting me. I appreciate the opportunity to share a topic I'm so passionate on. All right, so 1031s, how long have I been doing it? Asset Preservation as a company is a national 1031 qualified intermediary. As a company, we've been doing exchanges since 1990 and have facilitated well over 200,000 exchanges nationwide. I've been with the company for 20 years. Prior to joining Asset Preservation, I spent 14 years as a commercial broker and then 14 years as a banker. Wow. So that's kind of my background. So it's kind of a natural getting into 1031s.
It is, great. And one of the coolest names I've ever known, and we've worked together for a while, and you've been great. So appreciate all your help with clients along the way.
My pleasure.
So in that, I've had clients that are looking to do 1031s, and a lot of them don't even know where to start. They don't know the basics of it. Mm-hmm. Can you just go through with us what are some of the basic requirements for doing an exchange?
Sure. Yeah. When you're doing a 1031, think of it, and there's requirements for it because it's actually a part of the tax code itself. So think of a 1031 as a continuation of investment real estate. You're going from one property to another property or multiple properties. So the government is allowing the taxpayer to defer the tax on the sale of that property. So in order to do that, there's going to be four basic guidelines that you need to comply with in order to defer the tax. The first requirement is going to be the property requirement. So is the property that's being sold, has it been held for investment or has it been held for trade or business? So that's one of the major requirements. The second requirement is how much money you have to spend in order to defer the tax. We like to call that the exchange equation. So in order to defer the tax, you need to purchase property equal to or greater than your sale price after the closing costs such as title, commission, transfer tax, escrow fees and such. You have to spend all of the cash and you have to replace the debt. And then the third requirement is going to be the timeline for the exchange.
Yeah.
The fun part. All right, so when you get down to the timeline, regrettably the IRS doesn't give you forever to find your investment property and to close the new deals. So you have 45 calendar days to identify what you're going to buy. And then I like to say you're going to have an additional 135 days to complete the transaction. Because when you add the two together, the 45 and 135, it gets you to the 180. So people hear, well, I've got 180 days to complete my exchange. Sometimes they get confused and think that the 180 days is plus the 45. And it is not. It's inclusive with the 45. Okay? And then the fourth requirement, which is probably one of the most difficult as well, is that you have to identify the property or properties that you're going to purchase as a part of the exchange, and that's a formal portion of the exchange. It's very technical. So if you have those four requirements, you're definitely right on path for the opportunity to complete a successful exchange.
Well, good. Okay. I know the timing one always kind of throws people off. I've run into that. Make sure my phone is off here. Sorry about that. Okay, so of those four, let's get into them a little bit more. So,
sure.
So people explain, you mentioned property qualification. Can you talk about what properties qualify or what don't?
Yeah, definitely. Anybody that's been around and heard about 1031s, they hear the term like-kind property.
Right. Yeah.
All right, and so sometimes, yeah, exactly. People think like-kind, I'm selling an single-family rental, I have to buy a single-family rental.
Yes,
I've had people that go, well, I'm selling my single-family rental, it's 3 bedrooms, 2 bath. Do I have to buy another single-family rental with 3 bedrooms, 2 bath? The answer to that is no. All right. So when you hear like-kind in a 1031, like-kind basically means investment real estate. It has to be real property. So I can go from, say, for example, a single-family rental. Maybe the value of that single-family rental is so huge, I maybe want to get into an apartment building. Or if I have a shopping center that I want to sell, I can go off and buy either an industrial building, or I can buy an apartment building, or I can buy multiple single-family rentals. So think about it. It's just investment real property. Now, sometimes people think, well, is my primary residence considered something that I can do a 1031 with? And the answer to that is no. If the last use of the property, so say you're selling a house that you're living in and there's nothing else going on with that house other than it's your primary, you cannot do a 1031. That's a completely different tax code. So when people have gain in their primary that exceeds the exclusion, because you know about the 250 and 500,000.
Right,
Well, just
right.
think about the people in the South Bay. Somebody's owned their property that they've lived in for 30 years. The gain is certainly going to exceed that 200,
It's
250
definitely,
or 500,000.
Right.
So sometimes they're under the impression that they can do an exchange with the excess gain. You cannot. You just get to pay the tax on any excess gain.
Right.
Now, there are strategies, that you can utilize to help mitigate that. And that would be, not to go too deep into it, but maybe you convert your primary to an investment property.
Oh, right.
Season it as an investment maybe for a couple of years. And then when you sell it, you can utilize both the primary residence tax code and the 1031 code.
I've heard that before.
Yeah.
We might need to talk more about that.
Yeah,
sometime,
no
'cause
problem.
That's an interesting topic. and
Exactly.
strategy. I think.
Yeah, it can be, definitely, especially with high appreciated properties. So anyway, so you can't buy your primary residence with a 1031 either. So if I'm selling my investment property and say I want to buy a replacement property in somewhere where I wish to retire. I'm going, well, okay, I'm going to sell this property, my investment property, now I'm going to go buy this property and I'm going to move into it. You cannot. You have to buy, it has to be held for investment. It doesn't preclude you in the future that you can eventually convert that property that you acquired as a part of an exchange into your
Right.
primary, but you certainly cannot do it at the moment that you acquire it.
Right. So maybe they could buy something where they want to end up, or a home they would eventually want to live in down the road.
Right, but they still have to maintain that they had the intent to hold that property when they bought it in the exchange for investment purposes.
Explain that intent. I know that's a bit, that's a,
Yeah, that's a tough one. All right,
term.
intent is something that is going to be, there's no black or white to it. I mean, intent is going to be determined by the fact pattern of the ownership. Was it rented out? How long have you owned it? Did you spend any personal time in the
Right.
property? Okay, so here's another one about intent, which sort of is going to piggyback on what I was going to say next, and what property doesn't qualify, and that's property that you buy that you intend to either fix and sell or build and sell.
Right.
That's considered dealer property. All right, so that doesn't qualify for a 1031.
the intent wasn't holding it long term.
Exactly.
It
Your
was
intent was to fix and sell. Right. So yeah. So intent is subjective, and I always like to say that you really need to talk to your tax person to determine whether you have established that intent in your ownership of the property.
Okay.
Because sometimes people go, well, how long do I have to hold the property
Right, I've heard that.
to establish intent? Well, there's the good news and there's the bad news, right? The good news is there's no mandatory holding period. The bad news is there's no mandatory
also-
holding period. So you're not necessarily safe if you've held it for 2 years or if you've held it for 12. So for example, there was a case a while back, I can't remember whether it was 2014 or something like that, but there was an investor that held a piece of property for well over 12 years. And they went off and did an exchange, apparently got audited, okay, because that's the only way you're going to
Right,
get caught.
that's it, yeah.
So they got audited, and then their exchange basically was invalidated because that taxpayer never changed the intent. Now, to give a little backstory, the intent when they originally acquired the property was to try to build it for development.
Okay.
And in certain parts of the country, and certainly certain parts of Los Angeles, it could take a long time to get that development underway.
Especially these days.
Exactly. And so that taxpayer, never changed their intent. So all those years that they were owning the property, then they were still trying to find ways to develop it. So ultimately, when they did the exchange, and like I said, that was like a 12-year holding period.
Right.
And their exchange was invalidated because their intent, the entire course of that ownership, was to try to develop it for resale.
So there's nowhere you write down your intent. Or do you?
Well,
how is that?
yeah, how
Just
do you-
based
yeah.
on what you've been trying to do with it? How did
Okay,
they
so how do you
prove-
memorialize that? I think it's kind of what you're saying. Well, I think you
Is
just,
there a way?
yeah, is that, maybe you put a plan together saying, okay, I'm buying this property and I'm looking at this and I'm thinking, okay, the rental rates are going to be this. I'm looking for my returns on that. So, I mean, to me, that's something you sit down with your tax advisor and you try to find a way, how can I make sure that I am going to, if I'm ever challenged, that my intent is going to be established.
Right.
But if time is, if you're renting it out for 2 years, 3 years, 15
Pretty
years,
clear, right?
kind of clear.
It's on your
that
taxes and investment
right,
property.
exactly. Where it starts getting really gray and dicey is when people have properties that they've owned for a long period of time and they have family members living in it and they've never paid
right.
any rent. Okay, how do we deal with that? So that's where you have to have a really good tax advisor to determine whether that property is viable for a 1031 or not, because they've
okay.
never been reporting any rent on it, and then
Right.
all of a sudden it's going to show up on your tax returns as, as a property that you said you held for investment.
Right, right.
So it could come into and open up another can of worms.
Interesting. So you also mentioned the second requirement, or the second basic part,
yeah.
is the tax deferral requirement.
Yes, yeah, we call that the exchange equation.
Okay.
So when you're thinking about a 1031, as I said initially when I started talking, think of it as a continuation of ownership, right?
Okay.
So you're selling one property and then now you're going to buy one property, you're going to buy multiple properties, because you can buy more than one in a 1031. It's not one for one.
Right. Okay.
So you're going to be rolling everything over into the new property. So when you're doing a 1031, it's not just the gain that's rolled over into the next property. It's the gain plus the basis. So in other words, what you originally paid for the property and all the adjustments accordingly. So all of that gets rolled into the next property. So that's why your target needs to be, the value needs to be equal to or greater than your sale price minus the closing costs, such as real estate commissions, the escrow fee, the title fee, the qualified intermediaries fee, property transfer tax fees, those types of things. Those are considered a part of the transaction. So in other words, if I sold something for $1 million and the closing cost came to $70,000,
Right.
then I need to buy property or properties of minimum of $930,000 or more.
Okay.
More is always good in a 1031.
Right.
All right,
Well,
because
good
that's a
point.
plus.
Because a lot of people think, oh, I need to buy for more than what I paid for my current property. But they can take the closing costs and everything out of it.
Yeah, the closing costs I've described.
Right.
Now, there are
Yes.
sometimes closing costs that are on there that are not a part of the exchange, such as I had to, I'm crediting the buyer $10,000, or I'm crediting the buyer $20,000, or I'm crediting the buyer with the prorated rents and security deposits. That's not a part of it. Those things are part of operating the property,
Right.
not a part of transferring the property.
Okay. That makes sense.
Yeah. So, and then you have to spend all of the cash. So it's not just meeting that, say, we'll use it 930 for the figure, right?
Okay.
It's not just finding something for 930 and not spending all the cash. You have to spend all of the cash and you have to replace the debt
Okay.
that was paid off.
So the cash that was left
After
came
the closing
from-
costs, yeah.
After the closing costs, and then the debt has to be the same or more.
If the more would be that you're buying higher.
Right.
Yes, that's when the debt would be more.
Okay. Okay. Good. That's helpful. So the timeline, we touched on that a little bit. So
Okay.
just going back to it, so people get confused because they hear 180 days, but then 45, and they think that, like you said, they have the 45 and the 180. I've heard that, but it's all part of it. And the way you explained it, of 45 days plus 135 is actually, that's a much better way.
I think it clarifies a lot. Yeah, because
Yeah.
it's not 225.
And you're saying that the IRS doesn't have a lot of flexibility on that.
There is no flexibility. Yeah, I wouldn't say they don't have a lot, but they have none.
Right.
Yeah, I mean, the only time that there's ever going to be any type of an extension on these timeframes is if you're involved in a presidentially declared disaster. Now, we've had a few recently. The floods in Kentucky.
Okay.
There was one out of the U.S. Virgins, but we don't really see a lot of exchanges coming out of the U.S.
Yeah.
Virgins, but Virgin Islands. But so floods, hurricanes, fires, those types of things. But you have to be involved. You have to have been impacted by it. So if you're selling a property here in the South Bay and there's extensions because of flooding in Kentucky, unless the property, you may live in the South Bay, but unless the property you're selling in that region of Kentucky that they've given the extensions for, you're not getting any extensions. So that rarely happens, but on occasion it can. But so you have to plan your transaction like it's not going to happen.
And then that time frame starts at the closing of the downleg, the property that
Yes.
you're selling.
Right. So it's not uncommon for people to think that, well, I'm in contract with a buyer, so I have to hurry up and identify my property before my
Right.
escrow closes. That's not the case. All right. So it's good to start looking. I'm not saying you shouldn't.
Especially if you only
Okay.
have 45 days. That's
That-
what I've run into. People don't realize. They think they've got 180 days to do the whole thing. Pick a property, close, and do all that. But they don't realize they've only got a month and a half, really, to identify.
That's it, yeah. And they're calendar days, not business days.
Right.
Yeah,
It's
so
like, oh, quick.
Saturdays and Sundays and holidays count. So, yeah, so it's not when you open up escrow, it's not when you list the property, it's the day the sale closes. That starts the clock. So when people say, well, how can I get an extension on the 45 days? Extend the closing of your sale.
Right, I was
That's
just
the
gonna say,
only
so
extension
if
you're
they
going
got
to
a
get.
little longer escrow on the sale, then that's a benefit to them.
Right, but then in this current market, that, are you going to get a buyer that wants to extend? So those are all your issues that you have to deal with when you're negotiating a
Yes,
transaction.
yes.
There's no doubt about
That's what our
that.
team runs into.
Yeah,
quite a bit, so.
exactly.
Just wanted to jump in here real quick and let you know we're going to have a second episode to this 1031 podcast, so make sure you don't miss it. Subscribe to our channel, turn on notifications. Dino is going to talk about the biggest challenge that she sees for 1031 investors. She's going to talk about boot, reverse exchanges, and tips on how to get started. So definitely make sure you check that out. And now back to this episode. Good. Oh, that's a really good explanation. You mentioned the last thing was the identification rules.
Yes.
Tell me more about that.
Okay, yeah, that's the most challenging part in a 1031 because you have to identify what you're going to buy. So people think, well, if I'm in contract with something, that's identified. That's not technically accurate. There is a form that the taxpayer needs to complete by midnight and have it sent in by midnight of the 45th day. Okay, being in contract does not mean that you have properly identified the 1031 property.
Right, okay.
Okay, so I like to say there's the technical and then there's the practical. The technical is the form that you're going to fill out. So as a qualified intermediary, when we're dealing with your clients, they're going to get a form. Okay,
okay.
on that form, it says, okay, it's got lines on it. It says, and our documents will say the property you sold, and then your 45th day is this date, your 180th day is this date, and there's blank lines going, okay, what's the address of the property? So you're going to write down the address, the city, and the state, okay? Now, there's 3 identification rules, so because that's what makes the ID a little bit more challenging, because people get confused with the rules.
Okay.
All right.
What are those?
The first rule is the 3 property rule. So basically, you're limited to 3 addresses.
3 addresses.
But you're
Okay.
not limited to the dollar amount for each and every one of those properties that you're putting on the list. Okay? So, but people go, well, God, I really want to have some more properties to identify. Why can't I identify more than 3? Well, technically you can. But, all right, but be very careful. Now you're out of the 3 property rule and you're into what's known as the 200% rule.
Oh, got it.
So
I've heard that
each
one.
rule, if you think about it, as I'm going to explain it, is going to default to the next rule. So you start off with the 3 property rule. If you want to identify 4 or more properties, now you're going to default to the next rule, which is the 200% rule. Another way of looking at the 200% rule, think of it as the 2 times rule.
Okay.
Okay, because when you list 4, 5, 6, 10, 20 properties, the values of each one of those properties, after you've added them all up, cannot exceed 2 times your sale price.
Okay.
So think of it from a practical perspective now. I sell $1 million property here in Redondo Beach. Okay, is there still $1 million property in Redondo? $1.5 million, 2, 3.
Maybe not multi-units.
Yeah. A tear down 2-bedroom, 1 bath,
Right,
1,100
right.
square foot house. Okay, so you identify, so you sell, say, $1 million house, because this is easy for the math.
Yeah.
If I intend as an investor to reinvest in the South Bay, what's the likelihood of me being able to identify 4 more properties that are not going to exceed $2 million?
Right.
I'm saying it's slim to none.
Right.
But if I sell here in Redondo Beach and I decide that I want to diversify into other parts of the country, So maybe I want to buy a single family rental in Arkansas, or Alabama or Florida or North Carolina,
Right,
Tennessee,
okay.
Texas. Well, if you're buying single family rentals in those regions, prices can be as low as $100,000, and such. So if they're in the $150,000 range, could you now fit under the 200% rule? Sure. So to me, what's going to dictate the rule the taxpayer is going to be able to use successfully in their exchange is how much you're selling for and where you intend to buy. So if I see somebody that's selling for a small amount and they're going to stay in the same area, I'm going to tell them, you're in the 3-property rule.
Yeah.
Game over. You're not going in anything else.
Right.
Because if you're not careful and you identify 4 or more properties, but the values exceed 2 times the sale price, now you're defaulting into the third and final rule.
Okay. What's that one?
The 95% rule, which says basically unlimited properties, unlimited dollar amount. Now don't get excited because you have to close on 95% of the aggregate value of all the properties you've identified. So theoretically and practically, you have to buy everything on that list.
So anything you identify, you got to buy it.
Exactly. So you do not want to go to the 95% rule.
Okay.
Now, another component to the identification, which I find is interesting, because I'll hear people, from time to time in conversation, they'll go, well, my friend told me that all I need to do is just put addresses on this piece of paper, but I can buy whatever I want. I said, no, you can't.
Yeah.
See, when you fill out the ID form, those are the properties that you can only buy in a 1031. You cannot change your list after the 45th day.
Yeah.
So most people doing an exchange aren't going to fill out the ID form until they get closer to the 45th day. Because hopefully by that point, you're already in contract with the property or properties that you're going to close on.
Okay.
That's what that's the ideal situation, that you're not just doing a Hail Mary out there going, oh, I'm going to try to see if I can get these 3 properties. Here's my list on the 45th day. And then now you go out there and you start making your offers and you go, oh, couldn't get that offer accepted. Oh, it's gone. So now what do? You're trapped.
Right.
So.
Yeah, they can buy that 4th property, but not through the exchange, right?
Well, not with the exchange money either, because we're holding the money.
Exactly.
See, so there's a lot of intricacies in the exchange. So I've had situations where somebody says, well, we just released, they've identified property. So they did the formal ID. Then they're past the 45th day. They go, okay, we're going to pay the tax. We don't care. But I've got property 4 over here that I'm closing on. I need you to release our money. We cannot release the money until day 181 because they have formally identified properties. So when you think about a 1031, it's not, this is a very technical transaction because you're dealing with a tax code and you have to comply with everything. So if somebody is on the fence and they're thinking, well, I don't see anything I'm going to want, then when you get to the 45th day, you have to make a decision. If you don't identify any properties, on day 46, the exchange is over because you cannot identify beyond that, then we can release your money.
So it's just if you identify something, then
Correct.
you're in for the 100
Yeah,
days.
yes, exactly. Because they technically have identified properties.
Okay.
So
those are the 4 basic requirements of an exchange.
yes. Now, if somebody is wanting to do what's known as a partial exchange, because that's what the boot would be, in most cases, that they don't want to spend all the money, they want to keep some cash out for whatever reason. Okay, maybe to have some reserves, whatever. Maybe put money in the stock market. I don't know. Whatever you want to do with it, you just know it's going to be exposed.
Right.
If somebody wants to do a partial exchange, it's very important to determine, are you still benefiting from the exchange? So, for example, I had somebody that sold a property. It was around $1.5 million, and they wanted to keep $300,000 out of it. So, in other words, their target was going to be to buy property roughly of $1.2 million. They said, we're willing to pay the tax on the $300,000. So now my next question is, what is the actual gain on the sale of the property? So how do you determine gain? Adjusted basis minus sale price, right? That's gain. Mm-hmm. If the gain was less than $300,000, then that taxpayer would not benefit from the exchange. Right. They're going to pay the tax on it like nothing happened. If the gain was $1 million, then they're still protecting tax. on the other 700,000.
Right.
So you can do a partial exchange. Sometimes it makes sense to do it, but you just want to make sure that if you're going down that road, you're still going to benefit from the exchange.
Yeah.
So these are
And
the
that's-
conversations I like to have because,
Exactly.
in some cases, maybe your gain is 130 and you want to keep out 100,000. Okay, do you really want to do an exchange to protect tax on $30,000?
Right.
So some people, say yes. Some people go, well, let me think about it.
Right.
Okay.
Yeah, they might not.
Yeah, it may not be worth it. I mean, what's the extra tax? And then you don't have to deal with all the timelines. It doesn't mean you don't go out and buy investment property, but you're just not caught to the timeframes of the exchange.
Tied into it. And that's why they talk to you, right? And I know
Yeah.
you're always,
I'm straight
you may
shooter.
talk them out of working with
I have
you,
done
right?
that, yes. Yeah, there have been times I'm not seeing where you need to do an exchange here. Are you sure you want to do this?
Yeah.
Go talk to your tax advisor to get the numbers accurate and then decide what you want to do.
Yeah, you've
So.
always been great about that. So and very available, which is
I try to be, yes.
helpful. Yes, it's always good. Well, good. Well, those are good answers to some of those questions. So, well, again, thank you very much.
My pleasure.
Incredible information as always. We appreciate you taking the time and
My
coming
pleasure.
in and going through some of this. I know it's second nature to you, but it's not to a lot of people. So
Understood.
That's a lot of really good information. So. All right, now, if you have any questions about 1031s, definitely reach out to Dino Champagne, Asset Preservation. Her contact information is going to be here on the screen. Definitely, let us know to keep the information coming. If you enjoyed it, subscribe, like, do all the good things you can do with social media, and make sure you see these when we release the next episode. All right, thanks, everybody.